October 1907, a Tuesday morning in New York City. Outside a marble building on Fifth Avenue, a line begins to form before sunrise. By 9 o'clock, it stretches around the block. Clerks, widows, shop owners, men in silk hats standing next to men in work boots, every one of them holding a small bank book, every one of them trying to get their money out of the Knickerbocker Trust Company before the money runs out. Here's what nobody in that line knows. There is no safety net under them. None. No deposit insurance, no government rescue plan, and no central bank, because the United States of America, the largest economy on the planet, does not have one. If the system goes down this week, there is exactly one force on earth that can stop the fall. Not the president, not the treasury. A 70-year-old private banker with a famous temper, working out of his personal library. That was not an accident. That was a choice. One America made and remade for 137 years. From 1776 to 1913, the country that invented the modern economy refused, again and again, to build the one institution every other financial power considered essential. It built central banks, twice, and killed them both, on purpose. So how does an economy survive like that? What actually held the whole thing together through wars, gold rushes, railroad manias, and panic after panic after panic? And what finally happened, on a secret island, behind locked doors, among men who wouldn't use their last names, that changed the answer forever? This is a story about money, but underneath, it's a story about a fear, a very old, very American fear of letting anyone hold the master switch of the economy. For 137 years, that fear won every fight it entered. Until one October, it lost. Let's open the vault. And the story starts with a young man doing arithmetic in the ruins of a revolution. In 1789, the United States was free, proud, and financially dead. The war had left the federal government owing roughly $54 million, the states another $25 million on top. The paper currency of the revolution had collapsed into a national joke. Foreign lenders looked at the new republic the way a bank looks at a man who has already gone bankrupt once. The man handed this wreckage was 34 years old, Alexander Hamilton, an orphan immigrant from a tiny Caribbean island, now the first Secretary of the Treasury. And Hamilton had an idea that most of his countrymen found somewhere between arrogant and terrifying. Don't just pay the debts. Build a machine. The machine was a national bank. One institution, chartered by Congress, that would hold the government's money, collect its taxes, lend it funds in emergencies, and, quietly, crucially, discipline every other bank in the country. Hamilton had studied the Bank of England and understood what most Americans didn't want to hear. Britain wasn't powerful in spite of its bank. It was powerful because of it. And he understood something darker, too. He called the bank a political machine of the greatest importance, because it would tie the richest men in America to the survival of the government itself. If the republic failed, their bank shares failed with it. Hamilton wasn't just building a treasury tool. He was buying the loyalty of money. That is exactly what horrified the other half of the founding generation. Thomas Jefferson and James Madison looked at Hamilton's bank and saw the whole revolution being reversed. A northern financial aristocracy planted in the heart of a farmers' republic. Jefferson's argument went beyond economics. Show me, he demanded, where the Constitution says Congress may charter a bank. If the government can conjure powers it was never given, then the parchment means nothing. This wasn't a debate about interest rates. It was the first great fight over what kind of country America would be, and it split the founders into the first political parties. Hamilton won the round. He persuaded Washington that the Constitution's necessary and proper clause covered it, and in February 1791, the first bank of the United States was chartered, capitalized at $10 million, instantly the largest corporation in America. And here's the inconvenient truth the bank's enemies never forgave. It worked. For 20 years, the currency held stable, federal finances ran clean, and when state banks printed too much paper, the first bank quietly presented their notes for gold and forced them to behave. It was a leash on the whole system. But a leash makes enemies. Every state banker in the country resented it. And by 1811, Hamilton was dead in a duel. Jefferson's party held power, and foreign investors owned some 70% of the bank's stock, a gift to every politician who wanted to cry that British money was farming America. When the charter came up for renewal, it died in the Senate, killed, in the end, by a single tie-breaking vote cast by the Vice President of the United States. One vote. Remember how cheap it is to kill a bank in America. It's going to happen again. What happens when you take the leash off? America found out in about 5 minutes. The number of state banks nearly tripled in 5 years, each printing its own paper. And then the War of 1812 arrived, and the government discovered what fighting an empire without a bank feels like. The Treasury reduced to begging loans from state banks at punishing rates, selling its bonds at humiliating discounts, and by the end of the war, teetering on the edge of outright bankruptcy while the British burned Washington. Philosophy is expensive. In 1816, just 5 years after killing its first central bank, Congress sheepishly chartered a second one, bigger this time, $35 million, and handed the country a lesson in how not to run it. The second bank's first managers were a parade of cronies and incompetence, insider loans, a land bubble pumped and popped, and in 1819 the young republic's first true financial panic, foreclosures sweeping the farm country, banks collapsing, and a nation learning the word depression the hard way. For ordinary families, it was the Continental all over again, in a new costume. The farm bought on easy credit in 1817 was seized by the sheriff in 1819, and the paper fortune of a boomtown turned back into forest. The bank survived the storm it had helped create, which, to the men losing their land, somehow made it worse. The public concluded, not unreasonably, that the bank was a casino run for insiders. And then came the twist nobody expected. The casino got a genius. In 1823, a 37-year-old Philadelphian named Nicholas Biddle took over the second bank, and decades before the term existed, started running it like a modern central bank. He expanded credit when the economy needed air, tightened it when speculation ran hot, kept the paper of 1,000 state banks honest by demanding gold from the reckless ones. Under Biddle, the dollar meant the same thing in Boston and New Orleans, the government's books balanced, and by 1835 the national debt hit zero, the only time in American history. By every measure that fits on a ledger, Biddle's bank was a triumph. But there was one measure it failed completely. It was the most powerful financial institution on earth, run by a private gentleman in Philadelphia whom nobody had ever elected to anything. And in 1828, America elected a president who had built his entire life around one conviction: men like that were the enemy. Andrew Jackson did not dislike the second bank. He hated it, personally, physically, the way you hate something that once hurt you. As a young man, Jackson had been nearly ruined by paper money speculation, and he came out of it believing, to the marrow of his bones, that banks were a con and paper money was a lie told by the rich to the poor. Now he was president, and in Nicholas Biddle he found the perfect enemy, refined where Jackson was rough, unelected where Jackson was the people's choice, master of a machine no ordinary man could inspect. In 1832, Biddle's allies in Congress, betting that Jackson would never dare veto something so respectable in an election year, pushed the bank's recharter through 4 years early. It was a trap, and Jackson walked straight at it with his teeth bared. To a visitor that summer, he spat out the sentence that named the whole war: "The bank is trying to kill me, but I will kill it." His veto message was unlike anything a president had ever written. Not a lawyer's memo, but a war cry. The bank was unconstitutional. It made the rich richer by act of Congress. It sold American prosperity to foreign shareholders. The Supreme Court had already blessed the bank's constitutionality years before. Jackson announced, in effect, that the court could mind its own business. The president would read the Constitution for himself. Then he took the fight to the country, ran the 1832 election as the people against the money power, and buried his opponent in a landslide. What followed was the ugliest divorce in American financial history. Jackson pulled every federal dollar out of the second bank and scattered the deposits among friendly state banks. His critics called them the pet banks. Biddle, cornered, did the one thing guaranteed to prove Jackson right. He deliberately squeezed the nation's credit, calling in loans to manufacture a recession, gambling that public pain would force Congress to overrule the president. Businesses failed. Wages stopped. And the country looked at the wreckage and drew the obvious conclusion: a single private banker had just punished an entire nation for crossing him. Whatever the argument had been before, Biddle had ended it. When the charter ran out in 1836, the Second Bank of the United States died quietly. America had now built two central banks and executed both. There would not be a third for 77 years. The master switch was gone, and the country was about to find out what the switch had been for. We told the story of what money itself became in those years in another episode: the thousands of private banknotes, the discount tables, the wildcat banks in the swamps. But behind that daily chaos sat a deeper problem, and it had a rhythm you could set a calendar by. Boom, panic, ruin, repeat. 1837, 1857, 1873, 1893. 4 times in 6 decades, the American economy did the same terrifying dance. Easy credit and a mania, land, railroads, silver, anything, then a spark, then the stampede, depositors racing to pull their money out before the bank died, banks dying because depositors pulled their money out, a prophecy that fulfilled itself in a matter of days, again and again. The spark could be anything. In 1857, it was a shipwreck. The SS Central America, a steamer carrying passengers home from the California goldfields, went down in a hurricane off the Carolinas and took 15 tons of gold to the bottom of the Atlantic with her. The banks of New York had been counting on that gold. Confidence, already cracking, snapped. Within weeks, banks across the country were refusing to hand out coins, and the economy simply seized. One storm, one ship, and a continental economy went to its knees. That is how thin the margin was. In 1873, the spark was prestige itself. J. Cook and Company, the house that had financed the Union war effort, the most trusted name in American banking, collapsed under the weight of railroad bonds it couldn't sell. The New York Stock Exchange did something it had never done before. It closed its doors for 10 days. The depression that followed lasted years. The worst of them, 1893, gives you the scale. More than 500 banks failed. Some 15,000 businesses went under. In the industrial cities, unemployment climbed toward 1 in 5. And the following spring, America saw something it had never seen before: an army of the jobless, Coxey's Army they called it, marching on Washington itself to demand that somebody, anybody, do something. The government's answer, roughly speaking, was that there was nothing in the rule book that said it should. There was no rule book. And each time, the same brutal absence at the center of the story. When confidence evaporated, there was no lender of last resort, no institution whose job was to flood the system with cash and stop the stampede. There were only private clearinghouses improvising, rich men deciding whether to help, and everyone else standing in line hoping the doors would stay open one more day. The system had no shock absorber. It had luck. The Civil War added a national currency, greenbacks, national banknotes, but not a national brain. In fact, the new system hardwired a fresh absurdity into the calendar. The amount of currency in circulation was tied to government bonds, so it couldn't grow when the economy needed it to. Every autumn, when farmers moved the harvest and the whole country needed cash at once, money got scarce and interest rates spiked. Every panic, 1873, 1893, then 1907, arrived in autumn. American finance had hay fever, and everyone knew the season. Farmers in Kansas understood perfectly whom the system served. Money sat cheap in New York vaults all summer, feeding Wall Street's games, then held the countryside for ransom at harvest. The suspicion Jefferson planted and Jackson harvested, that the money power was a machine built by the few against the many, wasn't paranoia. By the 1890s, it was a reasonable reading of the evidence. But the strange truth is that the country tolerated all of it. The panics, the autumn chokeholds, the ruin, for decades, because the alternative was the old nightmare, handing someone the master switch. It took a very specific crisis to break that resistance. Not the biggest one, the most embarrassing one. The Panic of 1907 began, as these things often did, with greed of the small, stupid kind. A copper speculator named Augustus Heinze tried to corner the stock of a mining company, failed spectacularly, and the failure lit up the network of banks and trust companies tangled in his schemes. Trust companies were the weak seam of the age, banks in everything but name, holding millions in deposits with thinner reserves and lighter rules, and standing outside the private clearinghouse that New York's real banks use to protect one another. When the run reached the Knickerbocker Trust, the third largest in the city, the Marble Palace from our opening scene, the clearinghouse looked at it, decided it wasn't their problem, and let it fall. On October 22, 1907, the Knickerbocker locked its doors with thousands of depositors still in line. Now the fire was loose in the whole district, and the United States government could do almost nothing. There was no institution built for this, which is how the fate of the American economy came to rest for 3 astonishing weeks on one man. John Pierpont Morgan was 70 years old, half retired, and at a church conference in Virginia when the telegrams found him. He came back to New York and turned his private library on Madison Avenue, marble, tapestries, Renaissance manuscripts, into the emergency headquarters of the entire financial system. What happened in that library over the next 3 weeks is one of the most surreal episodes in economic history. The presidents of banks and trust companies were summoned like schoolboys. Morgan's men went through their books and sorted them. This one lives, this one dies. Pools of rescue money were assembled by force of personality. John D. Rockefeller, the richest man alive, announced he would pledge half of everything he owned to steady the ship, and the Treasury Secretary shipped tens of millions of federal dollars to New York and effectively handed them to Morgan to deploy, the government of the United States, subcontracting its financial system to a private citizen. One afternoon at the peak of the crisis, the president of the New York Stock Exchange walked into Morgan's office and told him the exchange would have to close early. The money that brokers borrow by the hour had simply run out, and dozens of firms would fail by 2:15. Morgan told him that if the exchange closed 1 minute early, it might never open again. Then he summoned the presidents of the city's banks, and in about 15 minutes, extracted $25 million to lend to the floor. The exchange stayed open. That was the margin now. An afternoon, a room, one man's word. The climax came in the small hours of November 3rd. Morgan gathered the trust company presidents in his library to force them to rescue their own weakest members, and when they hesitated, he simply had the doors locked. The most powerful bankers in America sat trapped among the tapestries, while the old man played solitaire in the next room, letting the clock do the arguing. At 4:45 in the morning, the last holdout signed the pledge. Morgan unlocked the doors and let them go home. It worked. The panic burned out. The system survived, and that is precisely what terrified everyone. Because think about what the episode actually proved. The mightiest economy on earth had no mechanism for saving itself. None, except the personal will of one elderly man who owed the public nothing, answered to no voter, and would not live forever. Even the men who despised central banking looked at the library on Madison Avenue and did the arithmetic. Morgan was 70. The next panic would come. Autumn always came. And there was no second Morgan. The question was no longer whether America needed a permanent fire brigade for its money. The question was who would control it and how to build it without waking the ghost of Andrew Jackson. The answer began, fittingly for this story, with men hiding their names. On a November night in 1910, a private railroad car sat waiting at a New Jersey terminal. One by one, some of the most recognizable men in American finance slipped aboard. Senator Nelson Aldrich, so powerful the press called him the boss of the United States, so wired to money that his daughter had married a Rockefeller, a senior partner from Morgan's Bank, the president of the country's biggest bank, an assistant secretary of the Treasury, and a German-born banker named Paul Warburg, who had spent years arguing, mostly to deaf ears, that America was the only great power running its finances like a frontier town. They had rules, arrived separately. First names only, no surnames spoken where a porter might hear. One of them theatrically carried a borrowed shotgun because the cover story was a duck hunt. Their destination was Jekyll Island, off the Georgia coast, a private club so exclusive it was said that on a good weekend its members represented 1/6 of the wealth of the world. For about 10 days, in a clubhouse emptied of witnesses, 6 men drafted a blueprint for the thing America had been refusing to build for over a century. Warburg held the pen. The plan had a deliberately boring name, the National Reserve Association, and a deliberately unscary shape. Not one central bank, but a network of regional branches, holding the bank's reserves, issuing a currency that could stretch and shrink with the seasons, and standing ready, at last, as a lender when panic came. Call it what you like. It was a central bank, written in secret, by Wall Street, on an island owned by millionaires. Every man in that clubhouse knew exactly how that sentence would sound in a Kansas newspaper, which is why they denied the meeting had ever happened for more than 20 years. One participant admitted much later that he had been, in his own words, as furtive as any conspirator. Years later, a financial reporter named Bertie Forbes, the man who would go on to found Forbes magazine, pieced the story together and published it. The private rail car, the first names, the duck hunting island. And here is the perfect detail. Almost nobody believed him. The truth sounded so much like a bad conspiracy novel that it protected itself. The men of Jekyll Island kept denying everything anyway, for another 2 decades, just to be safe. And here's the irony. As a piece of engineering, the plan was good. Financial experts broadly agreed. It failed anyway, because it was Aldrich's plan, and Aldrich smelled of Wall Street, and the old Jacksonian reflex kicked exactly as hard as the conspirators had feared. The proposal stalled in Congress, seemingly dead on arrival. What saved it was politics doing what politics does. The 1912 election swept in Woodrow Wilson and a Democratic Congress hostile to everything Aldrich stood for. And then, quietly, the new men took the dead plan, filed off its fingerprints, and rebuilt it with 2 crucial changes. The governing board would be appointed by the president, not chosen by the bankers, and instead of one institution, there would be 12 regional reserve banks, so no single city, no single building, no single man could be accused of holding the master switch. The populists got their trophies too. The new notes would be obligations of the United States government itself, not of any private bank, so that no one could ever again say a Morgan or a Rockefeller stood behind the money in your pocket. Same engine, new paint, public face. Congress fought over it, amended it, and passed it in the last days of 1913, the Senate voting 2 days before Christmas, with a good chunk of its members already gone home for the holidays. On December 23, 1913, Woodrow Wilson signed the Federal Reserve Act, and the 137-year experiment was over. America had a central bank, permanent this time. Jackson's ghost got its concessions. The 12 regions, the public board, the careful avoidance of the very words central bank. But Hamilton, dead 109 years, had finally won the argument. Step back and look at the whole arc, because it's one of the strangest in American history. A nation is born in a paper money disaster and swears, never again will anyone hold the master switch. It builds a bank anyway, because Hamilton is persuasive, then kills it by 1 vote. It builds a second, watches a genius turn it into the best-run institution in the hemisphere, then kills it precisely because it was powerful enough to work. It spends 77 years proving it can live without one. 4 great panics, autumn money famines every single year, an economy that grew like a weed and crashed like clockwork, held together at the worst moments by clearing houses, luck, and finally, one old man locking bankers in his library at 4 in the morning, and then it surrenders, but on its own terms. It builds the thing and disguises it. 12 banks instead of 1, a president's board instead of a banker's, a name with no central in it. The fear never went away. It was written into the architecture. That machine is running right now. When markets convulsed in 2008 and again in 2020, the Federal Reserve created trillions and flooded the system, did in days what Morgan did in his library at a scale Morgan could not have imagined. Nobody stood in line around a marble building because everyone knew the vault behind the vaults was there. That absence of a line, that's the whole invention. But notice what never got settled. Who watches the master switch? 100 years later, every fight about the Fed, every audit demand, every rate cut feud, every conspiracy theory with Jekyll Island in the title, is Hamilton and Jackson, still arguing inside the machine they both built. So here's the question for the comments, and I genuinely want your answer. After everything in this story, the panics without a central bank, The locked library, the island. Who do you side with? Hamilton, who said someone must hold the switch? Or Jackson, who said no one can be trusted with it? The next time you hear that the Fed raised rates or printed billions and life just went on, no lines, no locked doors, remember the Knickerbocker and the man playing solitaire while the American economy waited in the next room. If stories like this are your kind of thing, the hidden machinery behind everything we take for granted, subscribe and open the vault with us. The archives go deeper than they look.